great. Thank you. Well, it's great to be here. Like I was mentioning earlier, I've been here about 6 times, and just noticed this conference has had so many different areas of alternative investments. So I'm extremely happy this time. Usually I'm on the metaverse panels, but now we've got something that's kind of TradFi, but still alternative. We're going to be talking about distressed debt, as we've seen with the many conferences that we put on in Canada. Quite a few investors and family offices are just waiting for things to get really bad and to jump in and get things for pennies on the dollar. My panel here has been doing that for years in the region, so we're going to start off with a bit of introductions. We'll start with Raihan and talk about the area that you're delving in the GCC and maybe how you've seen it progress over the last few years.
My name is Raihan Sheikh. I am the founder of Swinton Advisors. We tend to get involved in situations where they get quite bad. In particular, I take CRO roles and director roles.
I'm Naveen. I'm a managing director at Davis Kempner. We're a multi-strategy fund, but the DNA of the fund is very much distressed debt. We have currently around $35 billion of AUM. I sit in London, but cover the Middle East out of London, and we've been doing that for around 7 or 8 years. I would say in the region we've invested around $1 billion over time. Some of that's come back. So we've been here for quite a while, and we think there's been a real evolution over that time, and very excited to see how that evolution develops over the next kind of 5 years or so.
Hello, my name is Esteban Buljevich. I'm the vice chairman of Rothschild and Company for the Middle East, and I co-lead the debt advisor and restructuring practice. I've been in the region around 12 years, in Rothschild 3 years by now. Before I was, for 10 years, the group head of special assets at Abu Dhabi Commercial Bank, where, we faced numerous situations and we saw the evolution of the distressed debt secondary markets. So thank you for being here.
Ahmad, I'm the CEO and co-founder of Sancta Capital, Special Situations Fund focused on investing exclusively in MENA. We do, amongst other things, distressed in the region. The firm has been running for 10 years, and I've been in the region for 14.
Hi, I'm a partner at SC Lowy. My name is David Beckett. We've been investing in this region for the last 12 years and trading around the situations. We run about $3 billion in total in 2 main strategies: secondary credit, where we invest and trade around the secondary loan and bond space, and private credit, where we're providing lending typically in special situations. Like I say, we've been involved in the region for a long time. We've traded around 13 billion notional of volumes in distressed situations. I think we counted about 33 different situations around the region, so know the space pretty well.
Great, thanks, David. Maybe for our first area, we can talk about how the market might move from liquidations, where when there's a distress problem, everything just kind of goes to like absolute liquidations. And we can start with you, Raihan, with workouts and restructurings and how that's moved, because I know you're on the board of a few of these entities, and how that's progressed in the region.
So I think culturally there's been a shift in the last, if we go back to the Dubai world and we move forward from there, we've seen a bunch of names. Then you had a branch that basically went to liquidation. We've had the tools now, I think, to have a going concern culture. I think distressed debt works in 2 situations: even in liquidation, where you buy a liquidation claim, or putting in new money in a going concern and fixing the capital structure, which needs fixing rather than the business itself, which runs well. And I think the ecosystem has expanded rapidly, especially in I don't know if my colleagues agree with me, but in the last, I think, at least 3 to 5 years, we've seen that, and the tools are certainly here.
Esteban, looks like you had something to say there.
I mean, for sure, there have been a massive evolution in the landscape. I mean, from the like 10 years ago, I mean, yeah, you had a few trades here and there with David or with Ahmad, but situations eventually were procrastinated. There were no solutions. So over time, you could see an evolution where perhaps in a situation that Naveen has been involved, he managed to consolidate a group of banks that they couldn't make sense on how to find a way forward on a situation, and that has helped, and it helped in perhaps keeping the going concern alive. But for sure, the cases like, particularly in the UAE, cases like NMC or Emir Hospital, I do believe have given have moved the region to a next level, because now you know that on any situation, I mean, no matter regardless of the reason of the financial distress, whether it's macro, whether it's micro, whether it's out of some irregularity, fraud, whatever, a solution can be found, whether out of core or in core. Of course, out of core is always sometimes better. So that has been a big game changer. The second one has been the ability to inject new money, on a super priority basis and so forth. So, I mean, I feel that, and my colleagues will elaborate further, where we were like 10, 12 years ago and where we are now is quite exciting for the space.
Any other comments from that in the panel, especially like debtor in possession and such?
Sorry, I missed that.
Oh, comments on that as well as with debtor in possession and maybe new rules or regulations that have come out around that?
Yeah, of course. I think, just to kind of add to what my colleagues were saying, I think we went from a paradigm where essentially distress as an asset class was more about managing liquidations to soften the blow on the bank balance sheets to actually becoming an actual asset class in the region now. A lot of that has been driven by change in legislation, which has allowed rescue financing. The financing allowed companies to enter, bankruptcy to gain legal protections. And to be turned around and balance sheets to be resized. But also a big factor of it is the ecosystem has changed. So we've had a couple of big test cases that Esteban has mentioned, be it NMC, more recently KBBO, JBF RAC. These are precedence cases that, set a template for us to work with. And it's no longer, the cowboy land when I first arrived here in 2010, where you'd show up, come up with an idea, you think it looks great on paper, and then you discover 1,000 reasons why it's not going to work out. We now have templates and we have ways to kind of, operate and invest and predict risk. And if things don't go our way, find a way out. And that's, been critical, like I said, to make the asset class investable.
Interesting to pick up on that. It's the number of advisors and such that are around transactions versus just simply like bilateral negotiations. That's maybe some there.
Yeah, happy to pick that one up. I think I'll just supplement what the rest of the panel have said. If I look at what DK have invested in over the last kind of decade that we've been involved in the Middle East, we started with liquidations, and I think that tells you everything, right? So the Gasabi situation in Saudi, the AWOL situation in Bahrain. I think investors had a lot of confidence that you could go into liquidation estates where you had a trustee or an insolvency practitioner, and you'd get your money back, or hopefully get your money back and a bit of profit. But there wasn't that level of comfort around going into a corporate because there wasn't the legislation around it, frankly. And perhaps we'll come on to that shortly, right? But if I look at the evolution of the $1 billion or so that we spent over 7 to 10 years, we started in liquidations, and some of them are still running. The Gasabi situation in Saudi is still running. The Awal situation in Bahrain is still running. But we've had our capital back, and we're now making money. Now, I would say over the last 5 years, we've had a lot more confidence going into corporate situations where the objective is to have the company emerge on the other side, right? With the employees, the business, everything intact, but the capital structure changed, obviously. So that would be my kind of overlay on the kind of excellent comments that the panel have made so far. On your specific question on the advisory side, look, I think this is now becoming, or is, I would say it is a sophisticated region on distressed debt. It's a genuine asset class in its own right, and there are a number of reasons for that. And I think the ecosystem around that is there's some very smart people here and some very credible institutions. So I would say it kind of ranks right up there with some of the other jurisdictions in terms of asset class and advisory depth.
Something interesting that has happened is that the market, both sides of the market, not just the demand side, but the supply side. I mean, like 10 years ago, I mean, when I was on ADCB, I started figuring out I should be trading and started meeting all these guys. Now I can say that in the UAE, the whole financial sector ecosystem, they have fluid relationships with investors in distressed paper on single asset basis. They have fluid conversations with litigation funders, for example, my colleague Dan. So most banks in the region at the moment, where they really know they have a portfolio that is an NPL portfolio or new situations that are coming. They have fluid conversations or alternative ways to pursue litigation if they want to keep the asset, or eventually moving to selling NPL books, what happened with the ECB. But it's quite interesting the evolution on the supply side. And I feel that my colleagues can elaborate on that, because yes, you can have a lot of investors coming, but if the banks are not yet there, then you know, like, but that journey has happened, and now it's quite an efficient and dynamic market with what Naveen say, with sophisticated people on both sides.
Yeah, maybe I could jump in, because we started coming here in 2010 when Dubai World kicked off, because some Taiwanese banks were involved, and they asked us about this thing called Dubai World, and there was no distressed debt market at that point. So we turn up, we do a bit of work, we realize it's really interesting. But over the next few years, it was really the international banks that were retrenching home, that were looking to exit these situations. So anything in some form of stress or distress, like a Dubai World or the dry docks or Nakheel, Al Ghassabi, we've mentioned a few of them already. It was mainly the international banks that were exiting. So we started having conversations. We became a lender of record, started having conversations with the local and regional banks. And over time, those conversations became more and more sophisticated and understand the value of that liquidity. Now, to date, we've transacted directly with 48 different separate banks in the region, including Islamic banks. I wouldn't say it's a deluge of opportunity, but it's certainly becoming more sophisticated. And all of a sudden, the last few years, couple of years in particular, we're signing NDAs in a number of situations that aren't just liquidations, aren't super distressed, but actual proper restructurings, where they're actually asking for our point of view on the value that their debt would be worth, but also what kind of options investors like us can bring to the table, new money options. Can we restructure the business in a different ways to keep the banks in the debt and us converting to equity or some other structure? So the sophistication in the market is jumping. I'm super excited for the next few years. The mid-market, private credit, all of these things are more exciting here because the legislation's in place, the environment, the ecosystem is all building to become much more into international standards.
I actually want to pick up on that. There's, having been in the region for the last 10 years doing distress, I think one of the most critical qualifiers that's happened, evolutions that's happened is actually around data integrity, where in the past, to Naveen's point, it was mostly liquidations that we would get involved in, or you would get involved in situations where you had no price discovery and you had to essentially underwrite what you thought was a theoretical liquidation value. Therefore, you work something out that is consensual, might take a little bit of time, that's out of court, to eventually get the upside. But you hedge yourself by buying stuff as close to liquidation or your theoretical liquidation value as possible. Today, I feel with the evolution of the ecosystem, better advisors, better legislation, data integrity is improved. That, as an investor, I'm not walking in blind. I can come in, there's proper advisors, there's an independent business review that's being done, there's a skeleton restructuring that's been put together, some sort of proposal that can help me price the risk a bit better. And like I said, not walk in blind and start thinking about what my exit outcomes could potentially be.
Thanks a lot. And how about other, quite a few local banks here and foreign banks? Where do you see demand for the distressed market coming in from other jurisdictions? Are the Canadians coming, the Americans and such, to invest in Middle Eastern distressed opportunities, or is it mostly local markets?
It was your question around who the jurisdiction of the investors, or
Yes.
with
Yeah.
Look, I don't think. I think if the can I pivot to legislation on this, because I think that really for me is the crux on this is if you have the right legislative framework, the capital will come, and I think Saudi and the UAE now have the right legislative framework, and they have for a few years. I think there's a different debate to be had around the application of that, but hats off to the UAE and to Saudi for implementing excellent legislation, right? And as an investor, what is your main concern? If you're going to invest $1 billion in a region and you go to credit committee and you say, I'm going to invest $1 billion in the UAE, the first question is, that's great. You tell me I'm going to make 2 times my money, but if it all goes wrong, how do I get my money back? That's the fundamental question that every creditor has, right? If it goes wrong, how do I get my money back? And I think until this legislation was enacted, it was a very tough question to answer, which is why I think, to the point that the panel has made, a lot of focus was on liquidations because it was easier to get your money back in a liquidation. But there's now excellent legislation in the UAE and Saudi, and I think the key element of that legislation is you have eliminated holdout risk. And what do I mean by that? I mean, you don't need 100% of creditors to vote for a plan. You only need 2/3 by value and 50% by number. And what that means is you get rid of the lowest common denominator, right? Because if you have 10 banks, previously you'd have the one bank that would just say, I'm going to say no to everything, and at the end I'll get a 10% premium because I'm just going to say no to everything. That's disappeared. You now just need 2/3 by value, 50% by number. So I think that is a massive change. And I think that would be my answer to the question, which is, capital will come, capital has come. US, Canada, Europe, I don't think it matters, Asia, right? If the legislative framework is there, you can say to your committee, this is how I get my money back, then I think the jurisdiction of the capital, it will just come.
I think the next stage is going to be really interesting. So the buy side in this distressed market to date has pretty much been 100% international investors. And those investors tend to be like Naveen's fund in DK, where it's not a dedicated strategy for the region, if that's fair, Naveen. It's a large fund, and you're allocating a certain portion to some interesting emerging market geographies. And Naveen then has to do the analysis and justify why he should compete against his peers internally. Now that the legislation is in place, now that the environment and the ecosystem is in place to make it much more interesting from an investment point of view, will there become dedicated funds in the region, local sponsored funds in the region that will start looking at this more seriously?
I think that's a question of depth, to be honest. I mean, I'm sorry, Raihan. I think first what we're seeing in the region is probably more money, both local money and international money, that's actually coming into new situations, fresh situations, being private equity and now more recently private credit. You're going to have to wait for those sponsored transactions to go haywire before you start seeing, distress properly emerging in the region.
I was just going to add that actually, in addition to the legislation, to Naveen's point, you actually have got the application. Because I think in the last 2 years, and off the back of that, you've seen a lot of international offices open up. And actually part of my business is based on that, because a lot of international investors come to the region and need help. You've seen NMC close, which is really a fantastic example of being able to put new money and prime old debt, which is essential to a going concern bankruptcy. You can't do that anywhere in the world outside Chapter 11. You can now do that in the ADGM, and it's proved and tested, I hope. And then we have EHG, which some of my panelists can speak about. Again, locally done, delivered. And then we've got some other deals that we're doing locally in different regions. So JPF RAC, for example, is continuing using the new legislation. So we've got an example of big restructurings going on, applying the new law. And in Saudi Arabia, obviously, we had AHAB that happened to close after 2018. Bankruptcy law came through, which was an excellent piece of legislation. So you can see a huge sea change, not only in legislation, but in actual live cases working. And as a result of that, you have a lot of offices now being opened up by international investors in the region because they want to play more.
Yeah, and again, building on what Naveen said, like a few years ago, I mean, you would try to restructure consensually, And it was always the same game, like you have 10 banks, 7 will support, 3 will play intelligent. Depending on, the banks that had a minority position will play intelligent. You will get stuck. You will try to get new money. They will not make sense of themselves. Now I feel that first, not only there is an evolution in the soft infrastructure, bankers have improved, they don't play anymore these games, but eventually you also, now, for example, as an advisor, I mean, if you had a client, a corporate, like 5-7 years ago, you would advise them to go on a restructuring. And the guy will say, no, I'd rather keep on delaying and pretending that nothing happened. And you couldn't truly face the problem because, the guy will go on a restructuring. Then for 5 years, will get stuck with the bank. Now you can objectively recommend that you can get into a process, you can exit. There are precedents that in a certain period of time, you will get in and you will get out if you have support of majority lenders, if you need money. So it's much easier as an advisor to have a conversation with a client, no? With a corporate client facing difficulties. And from a bank's perspective, if banks get together on some sort of an ad hoc committee, COCOM, whatever you call it, immediately after a while, if they have 1 or 2 banks that they are becoming difficult, they just move on and they try to pre-pack a process. So from the education and the evolution on the soft infrastructure of banks, the awareness of the investors, and from the evolution on the judicial infrastructure, I mean, from all aspects, they have been growing at the same pace. So I'm very optimistic, to be honest, about the future.
How about these non-performing loans sales, Naveen? You have experience in that. Let's talk about that. We're getting close to the last 5 minutes. We'll have for questions.
I'll try not to talk too long about this. I could talk for a while. So we, this is a unashamed plug for DK. So we closed, I think the first material NPL portfolio sale out of the UAE. Don't sue me if I'm wrong on that. But we think the ADCB portfolio, it was called Project Turbo, the start of this year. They sold, right. This is all public domain. They sold about $1 billion face value of non-performing loans to DK. We were very pleased to be the preferred buyer, and we're now working those loans out. Just a couple of things on that. One is what did that portfolio look like, and second, what does it mean for the region? And I think my colleagues will have other insights on this as well. Just to give you a sense for the shape of this portfolio, I think ADCB did a fantastic job in pulling it together. It was about 35 kind of corporate SMEs, very good mixture of secured and unsecured loans, which a fund like ours finds attractive. We don't just want unsecured because we want to be able to anchor our thesis around hard assets, hotels, real estate, etc. So I think ADCB did a fantastic job of pulling it together, and they also did a fantastic job of implementing and executing it, because when you're doing something for the first time, it's hard. They had to go and get central bank approval. They had to work through minutiae of detail. As an investor, if you buy a loan in the UAE and you become a lender of record, the litigation can sometimes revert to step one. So you want to avoid that. So we had to structure an assignment mechanism with the bank. It got done, and I think it was great for the seller and great for the buyer. Look, I think there's a pipeline here. There's something like $500 million, if not more, of kind of loan book in the UAE, and I think there's been quite a lot of noise around the transaction. So I would hope that there's kind of more to come here, and it gives banks another route to accessing liquidity. But I'd open it up to others on the panel in terms of their views on the transaction and what it means.
The ADCB portfolio was huge profile, and it's been fantastic actually opening up the conversation. I speak to a lot of the banks in the region, and all of a sudden there's a huge upshot in the number of conversations around portfolios. However, I'll temper that a little bit in that a lot of the portfolios we're seeing, and I know the other people in the room are seeing, are spreadsheets of skip cases which are not really worth very much. These are super legacy, super old skip cases where there's very little value. And it's very tricky to see how that kind of makeup a portfolio is going to be successfully sold, particularly if the banks are expecting to get a more material piece of money for it. What Naveen just described about ADCB is a much more structured portfolio to create some value, some low-hanging fruit, some bigger corporate positions that are attracting the investor. And then, yes, there's a tail of the more challenging ones. Hopefully, through conversations like this, the local and regional banks will start to realize the value of that liquidity and to proactively manage their balance sheet in a more proactive way. But at the moment, we haven't seen a strong enough portfolio to come out to see that there'll be more of these in the very near term anyway.
Yeah, I mean, I would agree with that. I think ADCB was a very unique portfolio for the reasons that David is mentioning. But also inside the banks, I think when it comes to NPLs, I think there are vested interests inside the banks that prevent these banks from selling those NPLs. So when they want to sell you NPLs, they want to sell you the skips and non-recoverable stuff. That's the issue. Whereas ADCB was a product of a three-way merger, and there was an impetus to sell that portfolio. So hopefully there will be some more to come, but I'm not particularly optimistic. And I also don't think we have an NPL servicing culture in the region either. And again, that boils into the data integrity as well. I mean, I've seen data tapes for some portfolios where there's no data.
Great, thanks. Well, our next speaker is waiting in the wings, so we have about 3 or 4 minutes. Questions? I'm told this is a very lively group. If you have questions from the audience. There we go.
Oh, there we go.
Thank
Can
you.
I get a mic to that gentleman, please?
Maybe just stand and deliver. Yeah.
Thanks, but maybe Ahmad's the best one to answer this. We're talking about foreign investors coming in, looking at this asset class as it's emerged. What about local family offices in the region? Do you think they're getting sophisticated enough to look at it as an investable asset class? And David, you probably can answer this as well.
That's a trick question. You're trying to put me on the spot with some LPs that may potentially be in the conference, but I don't think we're quite there just yet. The asset class is still very new. The legislative framework, bankruptcy codes are still being tested. So I don't think the local investor base, and I include sovereign wealth funds in that bucket as well, I don't think they're quite yet there. And like I said, they're probably more equipped to do private equity and private credit, but not necessarily distressed as an asset class.
And on the private credit, we run private credit funds in Asia and in Europe, but not here yet. We find the conversations are still a way to go. The bucket of private credit is kind of the buzzword at the moment, pivoting from equity strategies to credit. But what we're finding is a lot of the thought around that is more venture debt than what we do, which is more senior secured, protecting the downside. We're all distressed guys, right? So we always want to protect the downside and then look at the getting good risk-adjusted returns. I find a lot of the conversations are more about the venture debt and mezz pieces and so on. So there's a bit of education, I think, probably to be done.
Sure, go ahead.
Relationships between various parties.
You mean relationship between creditor and debt, or relationship between investor and supply and demand, you mean? Well, I mean, if you think about the supply, I feel that banks, they will not sign NDAs openly to whomever comes, and I feel that the track record and credibility and the behavioral aspects of institutions like the ones that are represented here is quite important, because in a way, you're opening your books, you're showing situations that implies a certain degree of risk, you know, and also you also when you if you think more about collective processes, I mean, originally when we were here, it was the typical stuff, no, hedge funds, they come as, vultures, they will ruin the process. And over time, it became clear that they were contributing to the process, not ruining the process. So I feel that it's not a closed market. I feel that it's open to new participants, but I feel that any new participant will need to pay a little bit, the right to be respected and to be trusted, no? I mean, I would say.
Mm-hmm.
I was going to agree with that. I was going to say, actually, it creates an interesting dynamic because certainly on my side, I've seen larger local family offices team up with international investors to solve some of the problems. So that actual relationship actually helps distressed credit because in other markets, it'd be quite commoditized. So here, there is more opportunity because of that relationship, I think. And what were previously zombie credits, you're now asking people to use the local technology, but help them push the envelope with their own technology and thinking. And I think that creates quite an interesting market. And I've certainly seen that happen in the last 24 months and is happening.
Love it. So it's all based on relationships. We're finished. And Prequin's up now. Well, you'll do the
I have a
introductions.
question, no?
Thank you very much. I just want to put a more of a macro view on distressed debt. And I was wondering if your view of the macro world is that asset prices in general are recalibrating across all asset classes. And your business model relies on buying something that's undervalued or has potential to be sold at a higher value. Would you say that at this point in time, or even perhaps in the next 12 months, it's too soon to invest in distressed debt?
Whoever answers, you have about 10 seconds, just so you know.
Is there a specific person that question was addressed to? Or
Whoever feels
like
most competent.
Next 12 months.
Maybe I'll take this one. I think this cycle is going to be different, is the first observation. So I think GFC and COVID, you had very rapid dislocations and very rapid bounce backs. It feels like this cycle is going to be a lot more prolonged and over time. And so I think to your point, timing is everything. What we do here, though, is it's such a bespoke, special situations kind of environment that we're in. It's a lot harder to kind of say, do you wait 12 months, do you wait 24 months? We may well see great opportunities now, but I think my first observation would be in this cycle, patience is going to pay because I think it's going to be a slower cycle. It feels a little bit like the 70s where you had high inflation for a decade and there was a slow seeping away of value. So Davies and Kempner's view on this is, worst comes first. So be patient. There'll be great opportunities to come. And I think you're starting to see it seep down the capital structure, right? Or seep up the capital structure. Would we be investing in holdco PIK instruments or equity right now in a distressed environment? Absolutely not. You can get 12, 13% yields, maybe better in senior debt, performing debt. That's where you probably want to play for now. And then things will start breaking. And I think when they start breaking, you can be opportunistic in what you find.
I'll echo that.
it's okay. Go ahead.
Oh,
I'll
yeah,
give
no,
you 30
I'll echo-
seconds.
Sorry, I'll echo that. I think for us, it's less about finding opportunities. I think you're always going to find opportunities, and you're always going to think you'll find something that's esoteric or idiosyncratic. I think what's challenging in the current landscape is actually thinking about your exit. That's the trickier bit.
Thank you. And with that, thank you for the great questions, and thank you to our panelists for
Go for another
putting
whole half hour.
forward
Thank you.